All right.
All right, Nikki and everybody, we're getting pretty close to getting. We just got to get our compliance thing knocked out, and then we'll get the conversation going. So, just another 15 seconds or so, and we'll get the conversation going. Thanks for your patience.
All right, we're live, Chris. And all right, hey everybody, Josh Null here, Gulf Coast Financial Advisors. We are coming to you live via Zoom webinar. The person you see in the other panel view, his name is Chris Roper. He is a plan consultant, a success consultant with Qualified Plan Advisors. Chris and I have a mutual affiliation with Prime Capital Investment Advisors. That's an independent RA that's out of Kansas City. That's where we hang our license. And we are basically coming on for about 8 to 10 minutes to talk about the stimulus package, the market, especially with today and yesterday, and then also just kind of answer some general 401k related, retirement plan related questions. As anybody that knows anybody in our business knows that I've got to read a quick disclosure for both Chris and I. Advisory services offered through Prime Capital Investment Advisors, PCIA, a federally registered investment advisor. The following commentaries or responses are the opinions of myself, Josh Null, and Chris Roper, and are not necessarily the opinions of PCIA, are for informational and educational purposes only, and are not and should not be considered investment advice. Past performance is no guarantee of future results. No guarantees are expressed or implied. If you need tax advice, you need to see a tax professional. I think we covered everything, Chris. We promise we're still experts and smart here.
Yeah.
So, Chris, I want to kick this off with, we got three things we want to cover, and we want to have a little bit of urgency to this. It's 4 o'clock, 4:15 Central Time here. I'm down here in Fairhope, Alabama, which is near the Gulf of Mexico. You're in Overland Park, which is a suburb of Kansas City. Right now, we are both the only people in our offices. My office only usually houses my wife and I. Your office houses dozens of people, so it's probably a little strange there.
It's pretty quiet, that's for sure.
Pretty quiet, usually a beehive there. But I wanted to dive in first with the stimulus and some of the market volatility the last couple of days. Yeah, what have you seen? How have you been navigating that? What's your opinion on everything that's going on?
Sure. Yeah, I think the first place is natural to start is the Fed stimulus that's happened, and it's unprecedented. We have, when you're looking at actually what the Fed is doing, there is way more they're doing now than what they were doing back in 2008 in the financial crisis. The Fed is attacking this thing from all angles. It's unprecedented what they've been doing, from what they did in 2008 to even now, where they're buying even corporates and treasuries. And let me just break it down for everybody that's just joining on here. Really, what's happening, whenever you hear all this stuff the Fed's doing, they're just trying to make it easy for liquidity to happen in the market. What does that mean? It just means that there's money for both sides of the trade. So if people are trying to sell bonds, the Fed's going to be there to buy them. And there's not going to be a liquidity crisis. There's going to be money there and liquid. The plumbing, the back end of the market is going to be fully functional, which is what we want to have happen. Okay, so that's one big piece of what happened. And then today, another big piece was the fiscal side of things, which is what Congress has been voting on. They voted on today. And you're talking over $2 trillion worth of stimulus, money coming directly to your pockets. If you make between under $75,000 as an individual, you're going to get $1,200. It's going to, as you make more money, you'll get less of that. And as a couple, you can get up to $2,400. There's money for kids. So there's all kinds of great stuff coming from that. Plus, there's going to be backstops for small businesses for loans. There's going to be direct bailouts for affected industries like airlines and different things like that. So when you're looking at this, you're talking unprecedented on both sides, the Fed side and on the fiscal side. They're throwing as much money as they can at this thing to make sure that we are going to get out of it alive. And I say that a little tongue in cheek, and I don't mean to be disrespectful of people as like actual situations we might be life-threatening, but this is such a unique, and like what's happened is so unique that we really need this. Between the coronavirus on one hand, the oil is what's happening on the other hand. You have two black swan events happening at the same time, and basically the economy is shutting down at once. Think of it like your car, and you're driving down the road, you forgot to put oil in it, all of a sudden the engine seizes up, it stops. That's pretty much what happened to the economy. We've never seen that happen before. And we need all this stimulus. We need this to help us get through this after we get through these peak infections, the peak rate of infections. We're going to need this to get the economy going up and going again. Because if you want to think of it like this, and Josh, you might have a better example, but the best one I could come up with is, we're used to just going in. If we want to drive somewhere, we go jump in our car, we turn the car on and we drive, right? It's immediate.
Yeah.
You just do whatever you want to do. This is going to be like a steam engine, a steam locomotive, a steam car. If you want to go somewhere after this is done, once we get through it and get the economy going again, you're going to have to put the fire in the firebox and light the fire, and you're going to have to get the boiler hot, and you have to produce steam, and then you're going to be able to go. So it's going to be a huge process to get this economy up and churning and going again. And this is why we need all this money from the government flowing back into different parts of the economy, from the Fed side, from the fiscal side, so we can do that.
Well, and here's the thing on that, Chris. One of the things that people don't necessarily realize, there's a little bit of history behind the speed and the size of the stimulus. Any of us that were in real estate back in 2008, a lot of times, I had a friend of mine ask me earlier this week, he said, well, didn't they do a stimulus package then? I said, yeah, it was 10 months too late.
Yeah.
Yeah. I mean, it was 800 billion with a B, right? This is 2 trillion. And even back then in 2008, when they got it out, they operated at the speed that they thought they needed to at the time. And we all ended up okay over the long run, but in the short run, it was pretty traumatic. The difference between 2008 and 2020 is the fact that you were coupling that market crash, if you will, with an unprecedented virus that apparently the human body has never really truly dealt with, of that strain, right? So you like you said, you got kind of 3 black swan events really at one time coming down, and the government's always going to be a little, they're always going to move a little quicker as history moves along, because they pay attention to history. During the Great Depression, there's about a 4-year period there where the government basically tried to balance the budget, which is in a functioning economy is probably a noble thing. I don't know if, Chris and I will see that in our lifetime, but it's a great goal to shoot for. But in the interim, what they did is the economy completely collapsed, and you literally had people starving to death. You had people out of work, that kind of thing. So they're trying to get ahead of that. I get it. It's one of those things where someday the tab's going to be due, right? But I think that everybody looks at it as, well, we can pump in 2 trillion here, or we can have complete economic meltdown, right?
Yeah, it would have been Armageddon if the government didn't step in. I mean,
this starts hitting the credit markets, and then that's when the real, fan hits it. Yeah.
You're talking about runs on the banks. You're talking about, and even right now, 70% of our economy is based on the consumer and us going out and spending money. And how can you go out and spend money when everybody, hey, stay at home, everything's closed? I mean, I have friends that are in the restaurant industry. I came from the restaurant industry. You can't keep the doors open just on takeout food, and just paying the bills, paying rent. How do the servers that were serving people, and that's how they made their money. There's all these different people that are affected. The hospitality industry, hotels, casinos, they're shutting down. And these people, most Americans, as you know, Josh, and probably most of the people on here know that are listening to us, is that most Americans can't afford $1,000 emergency. It's like 80% of Americans can't afford $1,000 emergency. If the paycheck stops coming in, you're talking serious trouble, and people need help. And that's why the government had to step in on this.
Right. All right. Well, Chris, I want to shift gears to something that you know quite a bit about. I don't toss the word guru around lightly, but I mean, I do consider you, even though you're younger than me, I consider you a mentor when it comes to retirement, qualified plans, 401ks, 403bs, like that. So I've got 2 things to say to set the table for you. I've always held out that when someone is plowing money into a 401k or 403b or some other type of retirement plan savings, there's really 2 critical times in the period of those savings. One is at the beginning. The other is when you're almost at the end. Now, that's 2 different reasons. When you're at the beginning, and a lot of times when you're starting a 401k, generally speaking, you tend to be a little bit younger. You tend to be working for a wage, possibly a salary or per hour. And when you start putting that money in, there's a dollar equivalent to your time when you invest it. So you put in 10, 20 grand and all of a sudden you see it drop 5 grand. You're thinking to yourself, my goodness, I just worked 250 hours for nothing, right? So I think it's an emotional thing when you're getting started out, and I want to address that in a minute. On the flip side of that is when you're starting to hit the end of the runway. And what I mean, not in your life expectancy, but in your accumulation time period. This is when it is probably the most critical in your 401k savings lifetime to really be diligent on this, because you can make decisions right now. It's similar to what people went through that were retiring around 2008. You can make decisions there on drawdown coupled with a market decrease that literally mathematically you'll never come back from. And so I think it's really critical that someone has, if you've accumulated over the years on your own, it probably worked fine. Especially we had an 11 plus year bull run. Everything went up and up over an 11-year period. But I think you're at a point now where it probably might behoove you to look for some professional advice. I'm not saying me, I'm not saying Chris, I'm saying anybody that's got has a professional designation that can maybe help you look at rate of return risk and look at drawdown risk. So I want to set the table for you on that is, here's how I'll say it. The country boy, my dad told me the other day, he said, tell everybody that their 401k should be like their face right now. Don't touch it. Right. So what do you think? Let's start with the person that is accumulating in the 401k.
Yeah, because I have a lot of people on right now that are millennials. So let's start with millennials. Let's work our way down the pipeline as we're getting older and just talk to people about what does it mean. So realistically, when you're starting out from the millennials, well, the first thing that I want to address is we are, as a group of investors, the most conservative group of investors since Depression era babies. And that's because we saw our parents go through the tech bubble of 01, 9/11, 01 to 03, down markets down 50%. Saw their parents go through 08 and 09, again, market from peak to trough down 57%. And these are during our formative years. And people our generation is scared, okay? And they're scared of losing money, and they're nervous investors and scared. The thing that really scares me about this specific time period and those investors is most of them are put into an investment called the target date fund, which is great because it does it for them. And they most investors need help investing, and this is good. So it's a do it for me investment. It's good. The problem is that what we see with this is that they're really super aggressive, because from a textbook perspective, myself, the people that are watching right now, many millennials out there, we have a long time for the market to go up and down. And you see that, and that's a great thing to be able to invest aggressively for a long period of time. The problem is most people don't understand what they own. So to your point, maybe they have $20,000 or $50,000, and all of a sudden now it's down 30% because they're super aggressively invested. Well, now they get really scared. Okay, so what happens is in the brain looks at money kind of like it looks at food. So if you want to think about being back in caveman days, right? So you have a caveman, you have food, okay, things are fine. Well, once that food goes away, what does your body say? Well, without food, I'm going to die. So you kind of go into this fight or flight, and we got to get food. All right, so that's the situation we have going on. Well, your brain, we haven't come that far from those caveman days. Your brain still operates the same way. Your brain sees money as a way to eat, as a way to provide. So your brain, when you see your account go down 20 or 30%, or realistically, we talk percentages, people really care about dollars. Okay, you got a $100,000 account, all of a sudden you're down 30%, you're down $30,000. People get scared. Your brain goes in that fight or flight, and it doesn't make logical decisions anymore. We all inherently know buy low, sell high. But what our brain does is says, I want safety. I want to go to safety. So what's happening to these investors is we've put them automatically in these investments that said, hey, you know what? You can be aggressive based on your time horizon. We're putting them in there. And all of a sudden, the market's down, and they're already a scared group of investors anyway. And then what are they going to do? My biggest fear is that they're going to make bad decisions. And we see that time and time again, that investors in downturns make bad decisions. So to your dad's point, what do we want to do? Not touch it. my goodness, please, please, please don't make investment decisions right now unless you're talking to a professional, because you're likely going to make the wrong decision. We actually have statistics that show us on a rolling 20-year period, so think 1980 to 2000, 81, 2001, 82, 2002, that the average investor underperforms the market, what they should be, by 3 to 4%, upwards of 5% in some years. And it's because they make bad choices. So for all of us out there, not just the millennials, but for all of us out there, please don't make changes unless you're talking to a professional that can help you. Honestly, all I've been doing for the last 3 weeks is talking to, I travel the country, coast to coast, Canada, Mexico. And every time I'm out talking to people, I say, hey, if you get scared, when you get scared, call me. And they're calling me, and I'm walking people off ledges. I'm trying to bring sanity back into their world, give them good information, help take some of the emotion out of it, and help them make good decisions.
Chris, I think it's important to point out too, that a lot of times people will say, I lost 30,000 in my 401k. But the reality of it is, it's not a loss until you realize it. You know, it becomes a loss if you sell the position. Right now, it's a number on a screen, it's a number on a statement. Fair? Fair.
I would love to hear your thoughts, Josh, on I've had 7 or 8 meetings today with some actually a company out in New York, and trying to explain that specific concept to people, because it's my interpretation that when people see their money, they see it as a lump sum pile of money. They don't really understand how it's invested, what's going inside of it. So I'd love to hear your thoughts on how you talk to somebody about, hey, inside of your 401k plan, you're actually invested in actual companies.
Right.
So while your share price might go down, the value of the shares are going down, you still own the same amount of shares. So I'd love to hear your thoughts on that while I shut my door, because there's some people out here talking.
All right, go ahead. Well, I think that the main thing that we stress to everybody is a 401k, a 403b, an IRA. Sometimes, Chris, you've had this come up to people, and people say this, well, my 401k is no good. I heard they're no good. I need to do an IRA, right? And then you basically got to walk through is they really are just buckets. They are buckets that hold a variety of securities. So inside that bucket, if you will, a tax preferential bucket by the IRS. So on 401k, 403b, traditional IRA, simple IRA, SEP IRA, they are pre-tax contributions. The money grows tax deferred. When you take it out in retirement, that's when you owe income taxes on distributions. The opposite of that is the Roth IRA, which you put in post-tax, it grows tax-free. When you take it out in retirement, there's no additional taxes due. The point of that is, inside of those buckets, of those tax preferential buckets, is really just going to be a collection of holdings. Now, what you hope is those holdings are a combination of various equities, various bonds, fixed instruments, things like that match your risk tolerance in your time horizon. But Chris, who manages millions of dollars in 401ks, can tell you that coming into that situation, that's often not the case. A lot of times it's completely out of whack. And you'll sit with somebody and they'll say, well, I'm very conservative. I do not want to lose money. And you'll go in and they've got everything super aggressive, right? Or vice versa sometimes. So the point of that is, you got to remember, these are inside your holdings. For the most of your folks that are listening to this, they have a 401k, a significant chunk of those holdings are going to be probably in some type of target date fund, some type of mutual fund, potentially an ETF. Let's take the target date fund, because Chris mentioned it earlier. That is, inside of that target date fund is going to be where they actually are holding the individual positions in the different securities, the different pieces of business that you're looking at. As in a target date, what the goal of the target date is, it's intended to become automatically more conservatively invested as you get closer to your retirement date. If you don't know if you have a target date fund, kind of a general rule of thumb is, if you pull out your 401k statement right now and you look at your holdings, if there's a number after your holding, like 2045, 2050, 2055, there's at least a pretty decent chance you've got a target date fund, because that's saying that we are managing these bucket of securities and investments for you to retire at an estimated date around 2045. Now, in there, while you're having these holdings, the company themselves, you're holding pieces of companies that, generally speaking, for the most part, in a qualified plan account like a 401k, more often than not, you're not going to have incredibly risky investments per se. I mean, you're probably going to be invested in companies that are listed on New York Stock Exchange or in some kind of index. probably something you should, for the most part, know by name, or at least it's going to be mid cap or small cap. When I say small cap, that small capitalization, you're still talking billions of dollars in modern society. You're still talking pretty large companies, millions of dollars. So on these companies, if you have fundamentally sound holdings and your account is set up to match your risk tolerance and your time horizon, and you believe that we will get through this black swan event, and you believe that America will recover 1 year from now, 2 years from now, 5 years from now, 10 years from now, whatever your time horizon is, as long as the holdings that you have are in companies that you feel, that mathematically look like they will make it, then the only way you're going to have a loss right now is if you sell low, period. It's not a loss until you sell. Now, I'm going to tee you up for the next part of that, Chris, is that's all well and good for me. I'm Gen Xer, Mr. Gen X. I told a guy the other day on a podcast, I'm a Gen Xer with the mind of a millennial and the body of a boomer. So I got the bases covered. The point is, I'm going to tee it up for you. Everything I just said is all well and good. Let's talk about the person that's within a year or two of retirement, the swing to the other end of that.
Yeah. So, and I'm going to take off one stop before we get there. There's a lot of people on here and they want to know, hey, what should I be doing? Tell you what, every client I have, everybody I've been talking to, participants today I have been talking online across the country, is if you have cash, now is an amazing, amazing time to put it to work. And when I say put it to work, I'm talking about investing it, put it in the market. If you don't have cash on hand, increase your contributions, your deferrals in your 401k, your 403b, your 401a, your 457, whatever company sponsored retirement plan that you have. If you can increase your deferrals, increase your contributions, increase what you're putting in there, you're buying low. Okay. This is what we need to be doing. I've had in the last 3 weeks, probably a couple $1 million worth of money flown in from my current clients, just like people have extra cash laying around that we're investing, because we know when the market's down 20, 30%, then in a couple of years, the market is going to be in a better spot and it's going to be a really smart decision. So if you have that cash.
And Chris, to clarify that, no one can ever call the bottom, right?
Correct.
But you can make a reasonable estimation when things are on discount over the long run.
Yeah, exactly. Yeah, and we're not trying to call the bottom at all right now, but we know that from a historic basis, where we're at, we're in a really good spot to be buying. And that's one of the biggest things we want to tell people is like, hey, you want to buy low. People know buy low, but a lot of times people get scared and they're thinking that, hey, they'd rather sell. Like, no, this is the perfect time you want to buy. So now moving on into like what Josh was just talking about. Okay, what if you're close to retirement? Well, I really, really, really hope that everybody that was close to retirement, if you're a year out from retirement, you were talking to somebody like myself, or you had your portfolio set up before, a month ago when things were doing amazing. I tell people when I go across the country that until you can go and handle the ups and downs of the market until you get about 5 years out from retirement. So what happens if you look back at 2008, from the top of the market, they call it the peak, down to the trough or the bottom and back to even, took 5 years for the S&P 500, which is the stock market, what we call the stock market. And that's what I tell people. That's my gauge of, you need to make sure when you get 5 years out, you're really looking at your portfolio. You're really looking at what's going on, and you understand how you're going to transition from that accumulation phase, which is that building up phase. So think about your 20s, your first job, all the way up until 60-ish years old. You're building money, you're building wealth. Okay. So you want to do that about 5 years out from whatever your retirement date is, and then really start to figure out how you're going to transition that over into your portfolio into a spot where if we have a downturn like this, then, sorry, I got people texting me right now. If we have a downturn like this, your portfolio is set up to withstand that. So there's all kinds of different things that you can do. There's something called a bucket strategy. You can switch over to a dividend strategy. There's all kinds of different strategies that we use. And I mean, I'm a financial advisor, Josh is a financial advisor, and there's not one strategy that's right or wrong. And a lot of times, and Josh, I'd love to hear your thoughts on it, but we use, in my team that I have, we use multiple different strategies for different people. So we take their goals up here, their goals and their priorities, and then their investments, and we make sure the investments match their priorities and their goals. Okay. So every strategy is going to be different for every person. But what you want to be doing is you want to really make sure that you're set up, because people who are retiring right now, or if they just retired or they're getting ready to retire, you could have theoretically lost 5 or 10 years off your portfolio in a month's time. It's called sequence of return risk, and it's a little bit hard to explain without visuals. But basically, if you think about it, it's the order in which you get your returns. Okay, so if you get returns, negative returns in the last 5 years or the first 5 years of retirement, those are like your golden years for people that are getting close to retirement. If you have a negative downturn like we do right now, you can literally on the back end of your portfolio, and my hand's not going that far, but on the back end, you might run out of money 5 years, 10 years earlier because you have that happen if you don't have that risk mitigated. And most people do not even have a clue about that risk. I talk to 1,000 people a year or more, and when I'm talking to people, they don't have the only risk they're worried about is the market downturn. They don't know, they've never heard of sequence of return risk and how devastating it can be to their back in their portfolio. So making sure that you're having your portfolio set up when you're at 5 years out from retirement is critical to retirement success. As I would say, it's equally as critical as a younger person like my age, saving enough money, putting enough money away is a critical aspect of what you can't control. And the same thing as on the other end of the spectrum, where you're getting close to retirement, though you can't control what the market's going to do, but you can control how you're set up for that.
Right. Well, and Chris, on that note, to wrap up that piece of it, I believe you use e-money, correct? Like I do. Is that? Yeah. So for those of you folks not familiar with e-money, some people may have heard Money Guide Pro. There are actual ways. You got to remember, at the end of the day, a lot of this comes down to math. Now, in finance, it's not exact math, because no one can predict the future. And if anybody ever tells you that they can, in our line of work, you need to turn around and run. Yeah, but what you can do is you can use programs that let you look at where you're at, look at the decisions you're making now and how that impacts you long term. And Chris, quite honestly, what that may have fallen by the wayside over the last 11 years, because when you're used to just putting money in and seeing the value increase, you don't really worry about it as much, right?
Yep. Yeah, that's true. And it goes right back to how we do things is we take the stats of the average American, okay? Which honestly, it means nothing to you, Josh. It means nothing to me. It means nothing to anybody that's watching this right now. The average American doesn't mean anything, but we need some kind of data to build on. We take that information, and then we also take your personal information and we plug it together in. And then using the expertise of people like Josh and myself, that's when you can take it and start interpreting the data. And when you interpret that data, you can start making educated decisions. So instead of just guessing, instead of gambling, instead of just burying your head in the sand, which you see a lot of people do because they're just like, I'm scared, I don't know anything, so I'm just going to bury my head in the sand. Is if you have good data to start with, you have good national data you can use, you have your own data you put into place, and you have people with specialties like Josh or myself that can go in and really interpret that, help with educated. And you can't go through and mitigate every single risk there's out there. Okay. I mean, you could go buy insurance for everything, but it's not really feasible to do that. But what you can do is figure out what are the biggest risks for you and mitigate those risks, and figure out what's important to you, and figure out how we can best achieve your goals and your priorities, whatever those are. Because you put the same people on paper, and you put them in a room, and they have two totally different sets of goals.
That's right.
You're doing two totally different things with those people. And it's just based on the experience that we have in the industry and knowing how to help people achieve their goals.
All right, Chris, I've got a couple things to say as we start wrapping this up.
Sure.
We had a couple questions. One of them was, now before I lay this question out, please understand that Chris and I cannot give specific recommendations to people that we don't know their exact situations and blah, 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 blah. I think you all get it. But how do you all feel about buying into industries that are being pretty banged up, potentially even bailed out? So I'm gonna answer it this way. In some industries, what I don't know if a lot of people realize is that the commerce flow, and you touched on it earlier, Chris, but the commerce flow of the industry in America and really the world right now is heavily based on consumer. You made that, I think it was 70%. What a lot of people don't realize too is it's also based on that consumer being able to move around freely, and not just the consumer, but the consumer's information.
Yeah,
so
exactly.
My humble opinion is if you're looking at industries that are related to the movement of people or the movement of technology, then I don't think those things will go away. It would take something 10 times as bad as coronavirus to really shut the world down long term for the movement of people and the movement of information to stop enough to where some of the quality companies may eventually have to be bought or go out of business. Now that's as dancing around that question as much as I can, but the point of it is, I don't know, I'm here in Fairhope, Alabama. I do travel. You, on the other hand, travel all the damn time, right? And you have millions of people like you that are in constant movement. And when you're in constant movement, you're generating constant dollars, right? And so I think that it's a fair thing to look at some of those industries. And is this thing involved with the movement of people? Is it involved with the movement of commerce? And is it involved with the movement of information? And then make your decision from there. So, Chris, the other question we had, I'm going to save it for our next live video. It's concerning the timing of a 401k rollover. When you and I come back tomorrow or the next day, I want to talk about the difference between a 401k to an IRA transfer versus an IRA to an IRA, so on and so forth, and some of the things people need to consider on that. And then those of y'all that are listening, Chris and I are working together. To be honest with you, he doesn't need my help up in Kansas City and all the things he manages, but he's helping me down here along the Gulf Coast with some of my existing 401k plans and with some of the ones that we've been working on. And so you'll have both of us as a resource as we move forward on this. Obviously, technology allows he and I to be within constant contact of each other. And he also gets to fly down here every now and then when flight's not restricted like it is now.
Yeah, for sure.
So we're gonna be rolling. The point of that is y'all are gonna be seeing quite a bit of information from Chris and I, Chris Roper of Qualified Plan Advisors, and Josh Null, Gulf Coast Financial Advisors. You're gonna be seeing a lot of information from the both of us, specifically related to qualified plan accounts, 401ks, 403bs, 457s over the next couple of weeks. And the goal of this is to lay some groundwork for a podcast series that we have coming out. Honestly, to be honest with you and to be honest with Chris and everybody here, the timing of that podcast series, it's already recorded, but it'll be determined on the market volatility and how things start easing out. The information is great, but we need to handle the crisis first before we start getting back into some of the nuts and bolts of things. So we're going to be back in a couple days. I appreciate you all jumping on. We had pretty good participation here. We had some good questions. When we come back next time, we're going to give you an update on the market, the stimulus plan, all those things. And then we're going to talk about some of the fundamental things that investors need to be thinking about, especially those of you that are nearing the end of the runway and are having to make some decisions about your 401k versus that could be contributions, that could be allocations, that could be rollovers, because you all are going to be hearing so much noise. Your group is going to be getting bombarded with certain messages. And we're going to be talking about that when we come back next time. So, Chris, you got anything else you want to say in closing?
Yeah, I'd say last thing that we're going to do is, it's 6 or 7 years now, I've been traveling the country, meeting with participants in retirement plans and learning how to break down complex concepts and try to help people be able to understand them. So my whole goal is going to be to bring you the information you need in a way that you can understand it and digest it. We'd love to have your questions and thoughts on specific things you're going to do, but I've met with so many people across the country that really, I think what we're going to do is bring across what people right now are asking me and what they've been asking, and then help you. I think we're going to try to figure out a way. I do really well. 70% of the population is visual. So we got video going on today, which I don't know how good that is for me. Josh did looking a little better on the video. Is figure out a way to be able to give you guys some visuals, draw you some pictures, so it's easier to understand some of these concepts. I found with visual aids. So we're going to try to work on that for y'all. But looking forward to helping people in any way we can.
All right. So in the interim, tonight, tomorrow, before we come on back again, you all can reach us through Facebook. You can message us there. We'll have to take the conversation on a phone call after that or email, or you can find us on LinkedIn. But you can reach out to us, tell us that you got some questions. Understand, Chris and I both operate from the same standpoint. If you have questions, if you need help, that doesn't necessarily mean that we're going to be coming in expecting that you're needing to do business with us. We are here to help first, then we take it from there. So, Chris, I will tell you, compliance asked me to read this disclosure one more time. So if you don't mind.
Go for it.
Yeah. So folks, everything you just heard, advisory services offered through Prime Capital Investment Advisors, PCIA, a federally registered investment advisor.
Everybody, I really appreciate
the preceding commentaries.
First I've ever done anything live. It's pretty fun.
So. Myself, Josh Null, and Chris Roper, not necessarily the opinions of PCIA, are for informational and educational purposes.
Put some more information out.
Not be considered investment advice. Past performance is no guarantee of future profits. No guarantees expressed or implied. Consult a tax professional for your tax.
Thanks so much for everything. Bye.
So, all right, Chris, with that, I'm going to end it for today. You all reach out to me. Thank you all that joined us. We will be back. This Chris Roper, Qualified Plan Advisors, Josh Null, Gulf Coast Financial Advisors, and we're going to be really hammering home on the things that are on your mind regarding your 401k or your qualified plan, retirement plans. I think it's important. So that's all I got, buddy.
Awesome. Thank you.
All right, off we go.
Okay. So are you